Good morning, John. Good morning, Mary. How are you today? It's very nice to see both of you. Today, we're going to go over the financial plan that we built together for your family. In the last meeting, I asked you to collect a lot of information, and then you shared with me about your short-term and long-term financial goals. Today, I'm very confident to show you the result. Do you know most of my clients feel more secure after having a financial plan in place? Great. Let's get started. Have you received the executive summary that I sent early today? Before we dig in, has anything changed since the last time we met that may affect your financial situation? Good. If there's anything that pops up, please be sure to let me know. The purpose of this financial plan is to provide a framework for helping you to reach your financial goals. We are going to go over the strengths and the weakness of your financial situation. And I will give you my recommendations. At the end, we're going to talk about the action plan. Does that make sense? That's great. Because you are in the spending phase of your financial cycle, even though I know you have no concern about your retirement savings, and you are also willing to take a risk for your investment, I still think we need a little conservative for your investment. I used a moderate level of risk to develop your investment strategy and asset allocation. My strategy that you're going to see in a moment will help you to achieve your investment goals and also give you extra layers of protection. Sounds good? So let's take a look at the executive summary. You can open that. First is your financial health. Based on your balance sheet, your current net worth is $13.8 million. Together, you have a sizable net worth that can be used in reaching your financial goals. That's really good. If you look at your cash flow statement, in 2023, your income is about $1.7 million, and your expense is about $570,000. Because you sold the business this year, and the $1 million down payment has dramatically increased your income, and also tax liability increased accordingly. And you can see the federal and state income tax totally is $375,000. Have you realized that the tax expenses are outrageous? And I think this is a major disadvantage for your financial plan. I don't think you want to pay such high tax money to Uncle Sam, do you? Well, if we worked before you sold your business, you know we couldn't avoid taxes, but we definitely could plan something better. Since we couldn't change what had already happened, we can plan ahead for the future. Generally speaking, any high-valued asset that you want to sell in the future, for example, the highly appreciated stamp, please discuss with me beforehand. Then we can minimize the tax impact for the sale. Does that sound good? We also notice that all your cash and equivalent assets, more than $1 million, are sitting in one bank, the Central Savings Bank. You know that's more than FDIC guaranteed fund limit? The limit is $250,000 per person. For a joint account, you have $500,000 total protection when the bank fails. In addition, CD doesn't provide much liquidity when responding to unexpected expenses or emergencies. If in an emergency, you may have to lose the interest that have been accumulated in the past year. The rate for CD is also locked in, so you may be missing out on potential growth. So I think it's wise to move the $800,000 CD to another bank after it's matured. Yes, I agree. Next, let's move to risk management. In other words, insurance. We are going to go over all types of your insurance. First, the homeowner policy needs to be at least 80% of the fair market value of the home. In order to cover all the losses, you need to have at least $520,000 coverage. Your current policy provides only $400,000 coverage. Give you an example. If there is a $100,000 loss, the insurance company is only going to pay you $76,000, and you have to come up with $23,000 plus the deductible. Second, long-term care insurance for both of you are needed. According to the IRS, in 2023, long-term care premium for John, $5,960 tax deductible. For Mary, the deductible amount is $4,770. I'm talking about the tax deductible. You have to use the itemized deduction, not the standard deduction. Actually, the IRS give you a tax break because they encourage you to have long-term care insurance policy. Next, the personal auto policy is not enough because you only have $15,000 coverage. But your 2019 Chevy automobile costs $35,000. If there is a loss of more than $15,000, you have to come up with the difference. So I suggest you to add more. In addition, based on the size of your asset, I think at least $2 million or $3 million umbrella policy is needed. Well, for a high net worth family, an umbrella policy can protect family assets from excessive injury, property damage, certain lawsuits, and even personal liability situations. Not at all. Umbrella policy is relatively cheap. It's about $300 for $1 million and $600 or $700 for $2 million. That's a smart choice. Noticed that your current annuity policy only has $102,000, which is way too little comparing with all your other assets. In order to avoid longevity risk, I suggest you relocate about 20% of your retirement asset to annuity, just for a steady lifetime income, or maybe for a certain year's income. Don't worry, we can help you to plan for this. The last one that we're going to discuss is life insurance. Do you know life insurance is used quite often for estate planning? Actually, life insurance is the most effective tool for wealth transfer. Your total assets are about $13.8 million. You use the current federal estate exemption of $12.92 million. you won't have a estate tax issue. But the law is going to sunset in 2026, and the exemption is most likely to go back as 5 million adjusted to the inflation. Furthermore, the estate tax exemption for Massachusetts is as low as 1 million. No matter what, you need to put the money aside for your children to pay for the estate taxes. Otherwise, your family asset will be shrinked in half after both of you die. Now, John has a 2 million coverage. I think it is enough for now. But the coverage for Mary is only 400,000, which is not enough. I actually know a very good insurance agent who can help Mary with purchasing the extra coverage. Her name is Maggie, and her number is actually on the attached document. Now we have done all the insurance. Do you have any question about the insurance? Oh, good. Actually, we're going to skip the investment session today because there are no major concerns for your current investment portfolio at this time. Once we take care of the urgent areas, we can revisit the investment planning in the later meetings. Let's move to the retirement planning and the tax planning. They are the most complicated area for financial planning. One of the factors that makes them the most complicated area is that the laws are always changing. I'm going to talk about both together because your retirement planning is closely related with the tax saving strategies. So it's very hard to separate one from the other. The good news is that you are in good shape for your retirement. However, because you are in the highest tax bracket, we recommend that each of you should continue funding the maximum retirement amount available each year. And we can help you to explore and evaluate the various plans. The whole purpose is saving the income tax. The current year, only John has 11,000 earned income. We actually can open 2 IRA accounts for each of you. The total deductible maximum funding for both of you is 11,000. And the maximum amount for one person is 7,500. As we mentioned earlier, you need to relocate about 20% of your asset to purchase annuity. My suggestion is to roll over your current 401k or 403b account to IRA accounts, and then to purchase annuity. This won't trigger any tax event. And after installment notes has been paid off, starting the next year, you can actually withdraw lifetime income from the annuity account. Or if you still don't need that money, you can consider the Roth conversion strategy to grow your retirement account tax-free. John, you look like you have a question. You can ask. You are right, John. This is called RMD, Required Minimum Distribution. When you reach 73, you are required to withdraw from your IRA account because the IRS just wants you to pay taxes for the money you have for years but never pay taxes on it. We have a strategy called QCD, Qualified Charitable Contributions. That will help you to satisfy the RMD requirement without increasing your taxable income. but we don't have time to talk about it today. We will save it for future meetings. As we discussed the last meeting, we're going to reinvest the 25% of the installment notes for future use. The 25% is about $10,000 per year. Actually, we can use the money to fund a IUL insurance policy for Mary. The cash value of this policy is going to grow compoundingly with an average 5 to 7% interest. It's also grow tax-free, and when you use the money, it's flexible, and we can loan it out. Also, it's tax-free. It's tax-free and flexible to use the money during Mary's lifetime. And there is no income tax to the beneficiaries. Okay, if there are no other questions, we're going to talk about the last key area for financial planning, estate planning. First, you don't have any essential estate planning document in place, such as a power of the attorney and healthy care proxies to manage your affair if any of you become incapacitated. Second, most of your estate assets are subject to probation if one of you die. My recommendation is to change the title of your homes and autos from sole ownership to joint tenancy to avoid probation. These changes would automatically transfer the property to the surviving spouse as the first spouse dies. Also, I noticed that both 401k and 403b accounts are payable to your estate, which further increase your probated estate. So you can add designated beneficiaries. All right, so far we have discussed your financial situation, including the strengths and the weaknesses. Our recommendations are aligned with your goals and will help improve your financial position. The last part is the action plan. Please write it down. This is going to be your homework. First thing, visit or call an estate planning attorney to obtain the proper estate planning documents, and probably trust to plan for either spouse incapacity. Is it possible to set up an appointment with an attorney this week? John and Mary, for both of you, can you do this together? The second important thing is to purchase more life insurance for Mary. You can call Maggie and let her know your needs. Maggie is really experienced and specialized in life insurance. Mary, when can you give her a call? No problem. You can also ask her about the long-term care insurance. If she doesn't sell long-term care insurance, she may know someone who can help you. The last thing is to call your bank this week to find out what options you have for the $800,000 CD. John, can you call and find out? Oh, wonderful. I think we had a very productive meeting today. I know it's a lot to take in everything at once, but after the meeting, you can review all the documents that I sent to you, especially the executive summary we just went over. If you have any questions, please feel free to call me or shoot me an email. I'm pretty good at responding to emails. usually within 24 to 48 hours. Thank you for trusting me to be your financial planner. It's my pleasure to work with both of you. Next meeting, can we do it in 2 weeks? We can review the estate planning document from the attorney, also the life insurance and the long-term care insurance policy codes. And John, please don't forget to find out from the bank what we can do with the $800,000 CD account. Do you have any more questions? Will this sound like a good plan? Okay, see you in 2 weeks. Bye.